Live from San Antonio is Cash Flow Mike, right? So this is one of my favorite things of the month to do. I actually look forward to this, right? It's only once a month. It's only for 30 minutes. And it allows me to touch base with the accounting community on cash flow type issues. So today we got a good one. Today we are going to talk about cost control and expense management. And it's going to be good. Going to be good. So a little bit about why I do this, right? I've been working with an insightful accountant for several years. And as a matter of fact, I met them probably 14, 15 years ago now. And for the last 2 years, we've been doing this monthly series. And I really enjoy it because I get to meet new people every single month. Some people that come through this become clients of mine. Some people are already clients. It's just one of those things where I love to get back and love to connect. So it's one of those things where I'm trying to do this. And I hope you're trying to do the same thing, which is I am on a mission to eliminate cash flow as the reason that businesses fail, right? So think about that. They say 82% of businesses fail because of they run out of cash. That's something we can make a dent in. That's something we can actually help people with, right? They can go out of business for other reasons, right? The partnership fails, any of those type of things, but not because they run out of cash. That's something we can solve. All right. So that's basically what we're trying to do. One of the statistics I always point out every month is 35% of businesses that file bankruptcy have net profit, right? Which means they're making money, but they can't pay their bills. And that's one of the saddest things that you see. And usually that's a timing issue. That's not a profit issue because their business model works. It's a timing issue. They simply run out of cash before they can, get things up and running. So let's talk about the one rule to rule them all. And I call it expense control. If you've ever read my book, The 7-Minute Conversation, or if you've gotten the free course from my website, Cashflow Mike, there's a free course on the 7-minute conversation. The second calculation in that book or that course is called expense control. And there is one rule to rule them all. And if you violate this rule, your company will die. I'll just be that blunt. Your company will die if you violate this rule. And here's the rule. If you have less money to spend, you should spend less money. Right? When you say it out loud, people go, oh, that's so easy, Mike. Yeah, everybody knows that, but everybody violates this rule at some point in time or another. I mean, we even do it on our own personal lives. So let's talk about what this expense control rule is. It is the change in operating expense should mirror the change in gross profit. Now, let me explain that a little bit differently. Gross profit is the amount of money we have to spend. It is the most important number on the income statement. It is the only place that you can get money to spend on your expenses or put in your pocket. You cannot spend sales. Sales is only a measurement of how much work that you do, right? Gross profit is the cash that you have. That's what you manage to. Successful business owners manage to gross profit. So the change in gross profit, and specifically when gross profit goes down, right? When it goes down, that means we have less money to spend. And if that's the case, we should spend less money. Think about it from your own personal life, right? In your own personal life, if you took a $2,000 a month pay cut today, would anything change, right? Would you still be able to make your bills? Would you still go to Taylor Swift concerts? Would you still, would you still save as much, invest as much? Chances are no, something's got to change. Well, that same philosophy goes into your business as well. When you have less money to spend, you have to spend less money. So when you look at businesses over time and you start to graph them, you'll see certain things happen on kind of repeat, right? First of all, you can see that sales, this is a company that's early on and they're growing. I mean, this is that hockey stick growth people talk about. Sales are climbing, they kind of level off and sometimes they dip a little bit, right? Ebb and flow, sales seasonality, it doesn't matter. But this is like sales are growing, and when sales are growing, money's coming in, right? And then it kind of tops off and then sometimes they start to decline. Well, I'm here to tell you that it doesn't matter this line. Remember, this is just a measurement of how much work that you did. You can make the same money no matter what sales level. So, and if we're doing it right, gross profit should match the trend line of your sales, because our pricing should be for a gross profit percentage. If we're trying to get 47%, then all of our pricing should be 47% of our sales should be gross profit, right? So managing the gross profit is pretty important because it tracks right along and mirrors your sales. Interesting, operating expense doesn't do that, right? Operating expense actually moves in a stair-step manner, right? As you're growing, you're increasing operating expenses just on occasion. Why do you do that? Tell me in chat. Why do you think operating expenses move in a stair-step manner, right? And they're not fluid and they don't track along with sales. Anybody know? Got an answer in the chat? So here's what's another interesting thing about this is that if this is the amount of money I'm spending and this is the amount of money I have, all of the money in between here is mine, right? That's profit. That's the amount of money I have to work with as far as profit goes to build on my transferable value, put in my own pocket, or reinvest back in the business. So that's it. Here's what happens as I'm growing. I start to hit different capacities. Like maybe I'm running out of space. I need another truck. Maybe I need more people. And so what happens is that an owner, when he starts to hit capacity, right, because he's making more money here than he was here, all of a sudden his employees start to tell him when they're stressed. They'll go, hey, if you don't hire me some help, I'm quitting, right? They're going to say things like that. And then what does the owner do? Oh, hire somebody and increases operating expenses, right? And then moves it up and then he holds it flat. The reason why they hold it flat is because the longer I can hold expenses flat, especially when gross profit is going up, the more money I make, right? The difference between these two. Well, that's all well and good as you're growing. But what happens when it starts to level off and maybe even decline? Some people would say, hey, do you make more money here or here? Put in chat, number 2 or number 1? Who's making more money? Number 2 or number 1? Kathy, you know this one. Jordan, you should know this one. There you go. Number 1. Oh, number 2. Number 2. Number 1. Linda Baker says 1. Rosalind says 1. You're making more money. You see the length here? This is all the money you're making. I'm only spending a little bit and making a lot. Even though my sales are higher at number 1, I actually make more money at number 2. That's what I'm saying. Sales doesn't matter, right? Sales doesn't matter. Are we able to see the recordings of past webinars? Kanesha, yeah, I think so. I think Matt, if you can give them instruction in chat, Matt works for Insightful Accountant on how they can get the past recordings. Okay, so you're going to make more money at number 2, right? Because there's bigger gap, bigger difference, even though sales are lower. Well, what's interesting is that you're starting to make less money, even though I'm selling more up here. But what happens if I keep expenses flat and you see how gross profit and operating expenses really start to come into a small gap, right? We're making a lot of money on this side. We're making a little bit of money right here, right? This is where we're making a lot less. I actually made more money at this sales level than this sales level. You'll see that, right? Because we keep adding expense. It takes an owner's decision to add expense, where sales is just selling. Gross profit runs with sales. So what do we call this area right there, where operating expense is equal to gross profit? Anybody know what that is? Operating expense is equal to gross profit, which means I'm spending as much as I'm bringing in. Yeah, break even. Andrea, good. Andrea's got it. Break even. I don't call it break even. I call it practice and working, because we don't do it for money anymore. We just kind of go in and do our job. We're not doing it for any type of money because we're making zero. Now we're not losing money, but we're not making money either. Now, on occasion, you'll see people move past this point when sales are coming down, operating expenses so high, gross profits starting to come down. you'll see people make the decision to hold their expenses flat. They're just going to hold them flat. Well, this is where you actually lose money, right? I'm actually spending more than's coming in, right? Spending more than's coming in. So I'm actually losing money. Now, for some of you that have been on this call or have seen me before, they know that my first job was as a state trooper, right? And so I used to go to networking events, go to networking parties, and people would always ask me the question. They'd go, "Hey, Mike, what do you do for a living?" And I said, "I'm a state trooper." What do you think was the next question I always got? Like 80% of the time, I got the next question. It was called, or yeah, there it is. The link to all the other ones are inside the chat now. There you go. The next question I always got was, "All right, Mike, come on, tell me, how fast can I drive?" And my answer was always the same, right? And it wasn't, "Oh, sir, you should drive the speed limit." My answer was always, "You can drive as fast as you can afford," right? If you can afford a $50 speeding ticket, well, then drive that fast. If you can afford a night in jail, then drive that fast. Which, by the way, in St. Louis County, it was 25 over the speed limit. We could actually take them to jail. So again, if you want to spend a night in jail and you can afford it, drive that fast. So here's the thing. I'm telling you that story because how long can you keep your business open when you're spending more than you're bringing in? How long can you do that? Well, the answer is pretty simple, until you run out of money, right? As long as you can afford. So here's what happened to a friend of mine in Lake St. Louis, Missouri. He was given some land by his dad. His dad was a big developer. He was a contractor. And he says, "Hey, I want you to develop this, this piece of land into a neighborhood." So he built a neighborhood outside, or actually right on Lake St. Louis. And it's beautiful. The average home price at the time was between 250 and 350. This was like early 2000s, before, the bankers burnt the world down in 2008. But around, we'll call it 300,000, right? Was right around the average home price. And the first year he did this, he had 5 homes on the market and he sold those. The second year, he had 35 homes all total because he was just cranking them out. And this was about 2007. In 2007, he built his own home as well. Remember, all the homes were around $300,000, and he built a $1.5 million home right on the lake. Stood out like a castle, right? It was great. It's crazy big in this neighborhood. It was like he was, Lord of the Lake or something like that. So I was over his house. It's 2007. We all can feel and hear the rumblings about this real estate tumble that's going to happen in 2008. I'm sitting off of his back patio, right? His back patio was overlooking the lake. He had a putting green. He had one of those infinity pools before there was even a thing. Marble, granite. This thing was beautiful. This $1 million home on the lake. He says, "Hey, Mike, what are you going to do?" Now, at the time, I had a hotel staffing company and I had 3-bar restaurants. Everything I did was with labor. So I said, "Well, if real estate collapses, all my construction workers that come into the bars and restaurants probably won't come in. People might lose their homes. They probably won't be going out to eat at restaurants. If that's the case, I'm going to have to cut back on labor, right?" So as people either quit or they resigned or got fired or whatever it was, I either didn't replace them or I replaced them with part-time people. Again, making this move where I'm actually making the decision to cut expenses, right? Come off of that line and cut expenses because I know gross profit's going to come down. He says, "You know what we're going to do, Mike? We're going to hold our crews in place." He says, "Because we think that as the real estate market tumbles, all of these properties around us will devalue, right? They'll be worth less and we can buy them cheap, and we can go in there and develop them during this cheap period and actually make a bunch of money." Now, that's a strategy that worked for a lot of people, right? It worked for a lot of people. They made a lot of money. It did not work for my friend, right? Because he said he was going to hold his crews in place while gross profit was tumbling. He wasn't selling anything. He just kept spending at the same level. The problem with him is he couldn't time when this was going to happen so he could start selling the properties again. He was just holding on to them and improving them and building and buying more. Well, he ran out of money. So by 2009, he started losing houses. In 2010, he lost that $1 million home. In 2011, he was selling mortgages in a strip mall. So I tell you that story because that's the cautionary tale. If you want to kill a company, just do this: spend more than's coming in. Because what you should be doing is making the move to where you're going to drop expenses, right? And if you're down 450,000 in gross profit, we'll say that's the difference between here and here. If I'm down 450 in gross profit, I have to cut $450,000 in operating expense. And if I do that, I will make the same money no matter the sales level. So the change in operating expense should mirror the change in gross profit. And you're going, well, does this ever happen? Yeah, you see it every single day in the headlines. When you see headlines like Meta lays off 7,000 people, how did they come up with 7,000 people? Well, that's because they saw gross profit drop by 7,000 people's salaries. So what do? They lay off 7,000 people. That's how you're able to maintain profitability, because if you go back to your business classes, the role of the manager in the firm is to maximize shareholder value. And what that means is you have to make profit no matter what the situation or what the climate is. And the way you do that is practice expense control. And if it works for Meta, it'll work for you, right? Is it weird to call it Meta? I mean, I'm like going, it doesn't sound right. I still like to call it Facebook. I guess I'm old. All right, here we go. So here's why it works. So I just showed you kind of the visual representation, but here's why this rule works. Let's just say in year one, you were selling $10 million and you were making $1 million, right? And this is kind of how it played out. You had 50% cost of goods sold, which makes 50% gross profit, and you're spending $4 million. In year two, here's what you see. Oh man, our sales came down almost $1 million, and our net profit came down 100,000. So the change was 900,000, 100,000. What should this person do? Well, if they were exercising proper expense control, they would see that the change in gross profit was 450, and they only cut $350,000. If they did it right, here's what it would look like. They would have $9 million in sales. They would still have $4 million in cost of goods sold. They would have dropped gross profit by $450,000. But instead of cutting $350,000, they would have cut an additional $100,000 to match, right? So from 4 million, they would have went to 3.550 to match the 450, not the 350. Then we could say, well, 4,500,000 minus 3,500,000 equals $1 million. So in this case, at $10 million, I made $1 million, or at $9 million, I made $1 million. And all I had to do was match these two numbers, right? All I had to do was match those. That's the mathematical proof that you can make the same money no matter the sales value. Now I know what you're going to say. Oh, Mike, it's hard to do this. Maybe it is. It depends. How much money do you want to pay to run your business? Because right now you're paying $100,000 just to be in business. That's why I talk to the owners, like on, you used to make $1 million, now you make 900,000 because you're paying the 100. It's coming out of your pocket. Are you okay with that? And if they're okay with it, so be it. If they're not, they're going to end up in a position where they're going to kill the company. All right. Questions on that? On time. All right. Still good on time. Good. Okay. So here's the visual that I give to my clients. Yeah, Rosalind, thank you. Here's the visual I give to my clients. How do I know what to cut? Well, let's start simple. Now I'm going to give you some granular. I'm going to give you some math too, but I start here, like going, can I afford it? And do I need it? Right? And this is one of the things that I like, just to keep it simple with my clients, because there's only one thing that I can keep. I can afford it and I need it. If I don't need it and I can't afford it, I should cut it. If I can afford it, but I don't need it, I should cut it. If I need it, but I can't afford it, I should cut it, right? That's kind of the first layer that I go through. And usually I make the client go through the first time, right? Just, hey, you make the first pass and use this chart and ask yourself this question on these expenses. And normally they can't come up with enough stuff. So what I do is I create kind of a chart form. I use, QuickBooks and I say, okay, I want the variance, but it's like percent of income and dollars in income, right? The change, percent change and dollars change. But what I'm looking for is where are the big money spenders at? And generally I'm looking for the expenses, right? Like why are these up $100,000? We'll just say, or I'm sorry, 100% because they weren't spending anything. So that's pretty easy to point out. But I want to focus on all the expenses and those changes. And I'm looking for the largest numbers, right? Those changes in percentages, those things that actually move the needle because I'm spending a lot of money in this area. And what I've come up with is that when you identify these large changes in percentages and large changes in dollars, that's where we can start to have the conversation. So what I do is this. I will take their expenses and I will say, hey, this is 5% of your revenue going to Google. And if we look down here, it was about 10% of all revenue was going towards advertising. This is one of the best places you can look for expense cuts. And you don't have to cut them all. You can actually readjust to what works because everybody just kind of throws a shotgun approach in marketing and does everything they can. And they feel like if they cut one of them off, it's going to hurt their revenue. Well, is it? Because remember, I'm looking for the large changes in percentage and dollars and then asking those tough questions. So the first thing I do is I look at over the last few years, how do you handle clients that won't listen and cut expenses? Great question. And I tell you, what I do is I use some of the techniques in the elevation sequence called, in my book called Don't Tell Me What to Do. This is a combination of things that I learned as a state trooper to get people to be committed to taking action and not just compliant because I told them to do it. When you say they won't listen, that's because you're telling them what to do. So there's ways to get somebody to believe, make them believe it's their own idea and they're going to do it because they said it. Right. And that's basically what I teach you to do is get people to say the thing because when they say it, it's absolutely true and they can't argue with it because they said it. So if they say it, they're going to listen. All right. So first thing I do is I always kind of go to advertising, marketing, whatever they're doing first. And I say, okay, what's our return on ad spend? If I put $1 towards advertising, how much revenue does that generate? And what we're seeing here is that in 2019 to 2022, his advertising got worse and worse and worse. He was putting money towards advertising, but every dollar he put in 2019 generated $20 in revenue. But by 2022, it was only generating $9 in revenue. So I'm like, okay, there's a problem with your marketing. I don't know if it's messaging. I don't know if it's where you're spending the money, but I'm going to start with the math side before we go to the marketing side. So the math side says there's a problem here, right? Because return on ad spend over the last 4 years has declined, which means I'm getting more and more ineffective. So I start to look at it, and he's got it broke out to AdWords and ads and home shows, and everywhere he spent money over the last year is in his profit and loss. So because of that, right next to it, right now, I know I overlaid it on top here, but right next to this, I create these 5 columns. It's how much did we spend? How much revenue did that generate? What was the return on ad spend? How many leads did we get from that source? And what was the cost per lead? And the math on this, spend is easy, right? It's already there. In fact, spend is already here. Revenue is something you've got to keep track of. If they're not doing it now, showing them something like this will help them want to do this in the future. Say, hey, listen, at first I just ask them because if they don't have any way of tracking this or they haven't tracked it, I just want to ask them about how much they think comes from each spot. And this client told me 30,000 from here. Almost all of it comes from Google. 20,000 from media print, 750 from pay-per-click management and SEO stuff. This is a waterproofing company. That's what they do. They waterproof basements. Well, let's just think about that from a logistical standpoint. Who's looking at Facebook ads because their basement's leaking and it's flooded? Yeah, that's generally not when you buy it. You go right to Google saying, "How do I get water out of my basement? How do I fix this?" Because usually there's an issue. That's why Google AdWords works for him. So the first thing as I put it to a logic test is, does it make sense that we would do a home show where people are trying to figure out if they're going to build a new deck, not waterproof their basement? Why are we doing home shows? And then I can show them the math. You got no money from the home show. You did get 115 leads because everybody dropped in their ticket or he scanned their badges or whatever he does at the home show. And you paid $15 for no money, right? Your cost per lead. 115 people talk to you. You paid $15 for each one of them and you got no revenue, right? Should we do home shows? Well, the answer is probably no. So we just picked up $1,700 for the next year, the next cycle. But what I'm doing at first is I just bold the things that I think look weird. Like, hey, listen, Home Advisor, this is the service he paid for. It only brought in 11 leads. It generated 60 cents. So you gave Home Advisor $1. Home Advisor leads gave you 60 cents. Would you do that? Wouldn't, I mean, because I'll give you $1 now, or you can give me $1 and I'll give you 60 cents back and we'll do that all day, right? Because I'd make the 40 cents. So, and it cost you $1,000 per lead, right? Probably not one that we should look at going forward. Then the other thing I'd look at is say, hey, listen, media and print. He got in one of those ad pages or whatever, and it cost him $41,000 because it went out every week all year long. And he got $20,000 in revenue. That means for every dollar he put in, the customers gave him 49 cents. So instantly, I've just found $50,000, $60,000 that we can do something else with. Then I look at what's really working. He did this advertising promotion with another company. It's kind of a partnership deal that brought in 6 leads, and brought in $30,000 and only cost him 1,000. So that's not bad. Then we've got Google AdWords, right? He spent 154 and he got 2.8 million, $70 a lead. Okay, I got a little bit more money here. If I don't want to cut the marketing budget, maybe I should pour a little fire on Google AdWords because for $70 a lead, it's generating most of my money. Maybe I can put more towards that. And lastly, you got this Service Direct business that he had, Service Direct. So it cost him this per year. It brought in a lot of business because people would go in. This is like Angie's List and those type of things. People go there looking for his type of service, and it only cost him $90 a lead, but it generated almost $100,000. So it cost him, or he's getting $14 back. So this is some of the ways that I highlight to folks what they can move or change. We can either cut $50,000 here or readjust it, right? There's options that we have. Return on ad spend is one of the ways that you can help people reduce expenses. And it's pretty simple. How much you spend, how much you bring in, then it's, revenue divided by spend, right? How many leads did it get? And then it's revenue divided by leads. It was cost per lead. But it helps you make decisions as you're walking through expense control. So you can go check out a free course. I got the 7-minute conversation for free on my website. It's right underneath the header. I actually, for this month only, right? I'm trying something new. If you want to dip your toe in the water on my membership programs, you can choose any of the membership programs and get started for the first month for just $50. I'm just going to try that this month, see what happens. But if you want to try and see what I do, including the app, including the video courses, including the live coaching, where I do this 15 times a month for an hour, put in first 50, right? First 50. I got a podcast called Mike and Blaine. And if you want anything from me, go to mike@cashflowmike.com. So I'm going to reiterate that. My special just this month, take your first step. Try to help people. Try to help me eliminate cash flow as a reason businesses fail. Use the discount code FIRST50 on any membership you choose and just try it for 1 month for $50. You'll like it. Questions, comments, concerns, moans, groans, gripes, complaints, otherwise. All right, y'all. Cashflow Mike hit my number, right? 10:30. Boom, on the dot. I was good. Book on Amazon. Yeah, all my books are on Amazon. Kanisha. It's all 3 of them. Don't be a dumb business owner, 7-minute conversation, and don't tell me what to do. All right, Linda, sending this month's deal to a few I know. Good. Hey, thanks, Kathy. Appreciate that. And if I can do anything for you, please let me know. All right. Take care.